You are overpaying on your taxes. I'll explain why in a second because in today's video, I'm going to show you exactly what you need to do in order to pay less in taxes legally. Because really, it all boils down to 5 super simple steps that I use with all of my clients. Just look at this client as an example. He was due to pay $34,000 in taxes before working with us. After working with us, he went down to owing only $16,000. Now, if you want us to help you save on your taxes, then click the link in the description of this video. So let's get right into it. Most people overpay on their taxes for one simple reason. They simply do not plan out their plan of attack before the end of the year. They really wait until next tax season, or most of us do this April 14th at 11:30 p.m., when really at that point, it's way too late to make an actual difference. The reality is the tax code, it isn't designed to punish you. Most people think that's the case. It actually is there to reward business owners who plan ahead. Think of it like when you were a kid and doing your homework. The earlier you do your homework, the better it is, or the better you do on a test, right? It's full of incentives. However, most CPAs, they don't really explain to their clients how to use them or how to qualify for them. Now, when you don't understand how to use a system, you end up overpaying. And let's be honest, this stuff isn't rocket science. It's not about finding loopholes or using all these crazy tricks. It really is using what's available to you legally so that you pay the right amount in taxes and you stop overpaying. The truth is, the people who pay the least amount, this is really crucial. They aren't gaming the system or using crazy loopholes. They're really just responding to incentives, the way that the tax code was actually written. And most importantly, you can't lower your taxes retroactively. You have to plan this before the year ends. You have to put these things into motion by December 31st and most likely by December 1st because it takes time to do these things. Now, before we get into the actual steps of how we can do this, we have to clear something up, something that every business owner needs to understand. You don't pay taxes on your revenue. Now, again, your revenue is what actually comes into your bank account. You pay taxes on your profit. Now, to review this, profit is all of your sales minus your expenses and your deductions. However, the problem is most business owners don't actually know what their real profit is. You guys mostly know what your sales are and your cash flow, but you don't actually know what the IRS is going to tax you on. Now, why it matters so much. If you don't know your profit, you can't plan. You're just reacting, and reaction is what keeps you from overpaying. Think of it in terms of the NFL. Why do they watch film so much leading up to the game? So they know that when the quarterback drops back, they know where his eyes are and they have an idea of where everything is. It's the same way in taxes. Since we now know that you are taxed on what's left over as a business owner, managing your profit really is managing your taxes. And that is why step 1 to paying less in taxes is so important, because if you don't understand this, you'll never understand your taxes. Here's the deal. You can't save on taxes or pay less if you don't know where your money is going. And let's be honest, most business owners, maybe some of you guys watching this video, you miss deductions all the time because your books are a mess. You simply don't know where you are. They've got personal expenses mixed in with business expenses, and it's just very hard to sift through all of that stuff. And then they hand their receipts or their shoe boxes to a CPA like me, expect me to close my eyes, squint really hard, and just be able to know everything. But that simply isn't the case. If your books are messy, then you are 100% missing deductions. Now, again, the concept is you cannot optimize what you can't measure. Clean books equals clear decisions, and in turn means you will pay less in taxes or lower them. Now, you might be asking, how do you fix this? These are actually really simple fixes. First, you want to make sure that you have 2 bank accounts. One is going to be your business bank account, and 2 is going to be your personal bank account. Every single business transaction, whether somebody pays you money or you pay money for supplies to make more income, every transaction goes through your business bank account. Now, we'll go over how to pay yourself a little bit later in this video. Number 3, you have to review your profit and loss monthly, not just at tax time. Now you might be wondering, how the hell does that work? I have to do this every month? Yes, you do. But if you use an actual accounting software or hire a bookkeeper, this makes it very, very simple. If you're using things like Excel, Post-it notes, Microsoft Word docs, that is not an accounting software. Pay the money, use an accounting software. You can use something like Wave, which I think is $20 a month, or you can even have a free version of Wave, or hire a bookkeeper. I promise you this will help you save in taxes. Now, as an example, again, if you keep all of your business and personal transactions in one bank account, it is almost impossible to go through and see, all right, this is business, that's personal, well, this Target thing, that may or may not be. You would have no idea. And I can tell you through experience that it is almost hard to capture every single tax deduction. And again, good bookkeeping, it isn't compliance, it's control. If you know where you're at, then you know how to strategize and pay less in taxes. Now, once your business is profitable, around $80,000, you want to start looking at paying yourself the right way and seeing if you can cut or pay less in taxes. When you are a single member LLC and you are filing what's called a Schedule C, ironically enough, you are most likely overpaying your taxes by 15.3%. That is what is called the self-employment tax. Think Social Security and Medicare. And you are paying that on every single dollar that you bring in. Now, again, once you hit that consistent profit, again, around $80,000, you want to consider what is called electing S corporation status. Now, what this lets you do is it lets you split your income between salary and distributions. Only the salary gets hit with the payroll taxes, that 15.3%. And again, you have to pay yourself a reasonable salary. The IRS's concept, or what I always tell clients, is what would you pay a normal person to replace you inside of your company? Now, let's say that you have a business and you have $120,000 as a sole proprietorship or a disregarded entity. That means before becoming an S Corp, you are going to pay about $18,000 in the self-employment tax. However, let's say that you decide to be taxed as an S Corp. Your LLC gets taxed as an S Corp. You would say that you would probably pay somebody $70,000 a year to do your job. Well, now that $120,000, $70,000 gets taxed as a salary. That means you're going to pay state, federal, and the payroll taxes. However, that other $50,000 that you took out, assuming you take out all of your profit, that $50,000, that only gets taxed on federal and state. You're going to save about $7,000 in taxes. So right there, you can cut your tax bill by about $7,000. Now, the reason why this works, the IRS taxes wages, not owner profits. As long as your salary is reasonable, the rest of it is payroll tax free. Now, again, the key takeaway here is you want to stop paying yourself like a freelancer. Start paying yourself like a business owner. That means you're going to pay yourself every 2 weeks or monthly. You're going to have a set schedule. Again, you want to pay yourself not like a freelancer, but now you are a business owner and the IRS lets you take advantage of these different tax strategies and ways to pay less in taxes. Now, here is where most people drop the ball. After they have their bookkeeping in order and they're paying themselves in the correct way and electing an S Corp, if it makes sense for you, is that most people, they do not think about their taxes until April when it's time to file. But at that point, the year is over. You cannot change anything. Once the ball drops at midnight, December 31st, and we all watch Dick Clark or Ryan Seacrest, it's over. You cannot change anything. It is completely over. The year's done, shut, locked up. Now, at that point, you are not planning. You are just reporting your income. So if you really want to save money, you have to plan ahead. The best tax savings, they happen before the year is over. Planning in Q3 or Q4, it lets you move around money while it can. In Q3 or Q4, You can do a lot of different things, like we talked about before. You can adjust your salary. Maybe this year you only need to pay yourself 60,000 and you can make more of it distributions. You can buy equipment or vehicles that you need cuz you'll know your profit. If you know your profit is 120,000, you're getting taxes on it, you have to find ways to lower that. You can contribute to retirement accounts. And number 4, one of my favorites, you can actually prepay deductible expenses. For example, you can pay for stuff that would be due in January. If you pay that early in December, you get that deduction before it takes place. And most importantly, you can actually set up your family on payroll. Think about paying your kids. You can shift money to them if they actually work in your business and you pay them on time the right way. Now, this was one of our examples, a restoration business. They actually prepaid $25,000 of insurance in December. Their insurance premiums are very high. And what they did was they talked to their insurance provider and said, can we actually just prepay our insurance that's due in March in December? Obviously, an insurance company's like, yeah, sure. They were already going to incur that expense. And it dropped their taxable income. They saved about $5,000 in taxes just by prepaying something and being ahead of the ball. Now, again, the key takeaway is after December, after the ball drops, you are in compliance. You are just reporting. There is nothing we can do. But if you're doing it before December, you are planning. You have to have this key thing in place because once the year ends and the ball drops, you are done. You have to be meeting with your accountant now. It is November 9th as I am explaining this or making this video. You should be talking to your accountant today. Now, let's talk about actual deductions and why this stuff matters. Because most people, they either get super aggressive and deduct every single thing and try to bend over backwards to justify it, or they underdeduct because they are scared. Now, again, the goal is to know what is legitimate and what is not. Again, the tax code, as we talked about, it is not a trap. It is not a I gotcha. It's a list of incentives. The problem isn't what you can't deduct. It's what you're not tracking. And again, the concept is deduct like a pro, document like an auditor. And again, a deduction, it's all about your business expenses. Think about this. If a business deduction or something that you're spending money on, it has to be ordinary, necessary, and reasonable. Let's look at actual legitimate deductions. Vehicle mileage. If you are driving to and from the work site, that is deductible because let's think about work trucks, construction businesses. They all have trucks. It's the same thing. It does not matter what your business is. As long as you are driving to and from work, you can deduct that. Think about business meals, document who and why. If you're going out to lunch with a client, a prospect, and you are going with the intention of speaking about business, then it's completely deductible. Now, where it is not deductible is if you happen to go out to lunch with your friends and they maybe bought one service from you and you talked about business for 30 seconds. That isn't it. You have to go with intention and you want to document who and why. Education tools and software, all the software, Zoom, Loom that I'm using, this camera that you guys can't see, but I'm looking right into, that is a deduction, right? You want to make sure that you're paying it and tracking it respectfully. Cell phone and internet, family payroll and retirement contributions. These are all legitimate deductions. Now, again, you want to avoid personal expenses on your business card or business bank account. Do not pay your rent out of there. Don't go to the hairdresser and pay with business. You want to keep everything separate. And again, vague client lunches. I'll give you guys an example. One of my friends, I do his taxes each and every year. I talk to him about business for maybe 10 minutes a year and the 30 minutes that I do his taxes. However, if we go out to lunch and we're just shooting the shit, that's not a deduction because that's very vague. However, if I go out to lunch with a client that I really only talk business with, then that is a business lunch. Again, vague client lunches, you don't have vague transactions and untracked cash. For most of my clients, I'm going to tell you guys, take credit cards, use Square, Stripe, any other payment processor, use that. If you start doing large cash transactions and it's very hard to track, it's going to be very hard to defend you in an audit. Now, this was an example of one of our clients. One plumbing company, they started tracking vehicle mileage every single week. They didn't have a dedicated business car, but they used their truck to go on business runs, and they also use it in their personal life. They only had one car. And I said, you might want to start tracking it. And it turned out that he was actually traveling almost 25,000 miles a year for business. And he was able to write that off. He was able to get an extra $14,000 in deductions, and it saved him $3,000 in taxes. He was not doing this the year before. Just by deducting intentionally and paying attention to what goes in and out of your bank account, it can save you thousands of dollars. And again, you want to deduct with a purpose. If you are staying ready, you don't have to get ready. Most people panic. If you deduct with a purpose and track all this stuff, you are not going to be panicking come tax time. Now, the fifth thing you want to do is you want to reinvest strategically, because this is where we move from saving and taxes to actually building wealth. Most people will ask you, how do I pay less this year? The better question is, how do I use those tax savings to make more money? And again, the concept is you do not save yourself into wealth. You do not save money and become super wealthy and put money away by saving on Starbucks. Now, do not waste money unfruitfully on Starbucks, because I don't drink a lot of coffee and I think it's a waste of money. But again, it's the same concept. You have to invest your way into it. You want to use your profits and tax savings to build future income. Now, what I like to have most of our clients, the number one thing I always want them to do once they've maxed out a lot of their deductions, they know where their profit is, invest into a retirement account, solo 401k, SEP, IRAs. There's so many different ones. We want to just focus on retirement in general. That allows it to grow tax deferred or tax free if it's a Roth for years to come. And as Albert Einstein once said, the eighth wonder of the world is compound interest. Now, he may not have said that, but I am pretty sure that somebody has said that. And you want to reinvest to things in that you actually need. Think equipment, vehicles. If you are a contractor or a plumber or install HVAC, if you get another vehicle, that means you can make more money. Things like that. Also, property and office space. If you want to buy your office space or buy a commercial building, that can also help. And also, you want to be hiring and training your staff, because if you give them benefits such as a 401k or retirement, those get into tax credits, which are tax deductions on steroids. Now, this is an example. Let's say we talk to a client and they have about $120,000 or $100,000 profit at the end of the year. And we ask them, is there anything that you might need this year or coming up? And a lot of times our clients say, well, I'm thinking about getting a new truck or new piece of equipment. We would say, well, if you're already thinking about it in November and December, maybe you can finance that purchase or buy it now. We had a client, they purchased a $50,000 truck, which was very, very heavy, and it qualified for what is called bonus depreciation, creating a $50,000 reduction this year and boosting next year's capacity. Now, let me explain why that is so powerful. If you have a $100,000 profit, kind of like in the example we talked about before, and you're taxed on what's left over, now that we know that, if you have a $100,000 profit, you're going to pay taxes on $100,000. Let's say 30% of that. You're going to owe $30,000 in taxes. However, if you know that you need a truck, and again, that you need it, not that you're just buying it just to have and it's extra. If you know that you need a truck and it's heavy enough, over 6,000 pounds, which we all hear about, if you finance a big truck like that and you put no money down or little, let's say $10,000 down, you can get a $50,000 deduction. So you can only pay $10,000 and you can finance the rest. Now your income went down to $50,000 by only spending $10,000. Again, that's where it is. You want to be redirecting your money from the IRS into assets that grow your business. And again, reinvesting, it's not spending to save taxes. It's funding your future. And when you do that right, you don't just lower your tax bill, you actually fund your long-term wealth. So let's recap this. Again, the 5 steps that we have with all of our clients, including the example that I showed you guys before, is number 1, you have to have clean books. Number 2, pay yourself right, plan before December, deduct intentionally, and reinvest strategically. In fact, that client that I showed you from example, we actually just met with him, and he literally did all 5 of these things. Now again, the tax code, it isn't out to get you. It's written for the people that know how to use it. And once you start using the tax code or responding to incentives, you don't have to out-earn the IRS or make more money. You just have to outplan them. And again, it's not so much an adversarial relationship. You just have to use what is in front of you. And again, as a reminder, if you want to be like this client who went from owing $34,000 for working with us and then to owing $16,000 after working with us, then make sure you click the link in the description of this video, apply to work with us, and we will get you on the straight and narrow. So let's get right to it, and I will see you guys in the next video.